Hello, everyone. This is Sergio Marrero with Rebel One Live. And today we have another special guest, Emanuel Pleitez, that he's founder and investor at Islos Capital, Stanford University graduate, Stanford Angels, also former mayoral candidate of LA. He was on the Obama-Biden transition team board. He's in terms of service, also served as well. So done a myriad of things, and I think you're I think 1 year older than I am. So I saw you. I was like, man, that's amazing. He's done all these things. I love it. So thank you for joining us, sir. And
My
it's
pleasure.
good to have you. Yeah. But diving right in, can you share a little bit more? I wanted to invite you today because of your just to explain a little bit to the audience. We cover founder and investors. We've covered a lot of venture capital. Venture capital is a small component of the ecosystem. Emanuel runs a private equity fund, and so we're going to dive into another ecosystem, and he's going to share more about that. So I'll let you take it away if you want to share more about Islos Capital.
Sure. Yeah. So Islos Capital, it's a new private equity firm, and I would say it's a private market investing firm. My partner and I have 23 portfolio companies as angel investors or as investors in other funds. And then in this new fund that we're building is going to be more lower middle market, but we're willing to go down to about 5 million of revenue. And so there is sort of, there could be firms or companies that we invest in or acquire that maybe already raise a Series A or even a Series B, and that we can come in and sort of kind of take them to that next level, or maybe on a different trajectory. So, but at the end of the day, Islos Capital, it's, I brand it as a tech-enabled private equity firm in that we think about how to tech-enable the whole process of investing, from sourcing to, deploying the capital to then the actual operations of the company. And we're willing to go from tech to also non-tech, because we believe tech, and specifically software, is essentially impacting every industry. And Islos Capital wants to make sure that, aside from only investing in tech, that we're looking at the rest of the world and the rest of the industries, because there's plenty of opportunities out there to, make an impact through investing.
That's great. And I know when we first met had crossed paths before, but hadn't met formally until the Latinx VC dinner in
That's right.
San Francisco. And I remember talking to you there, and it was a bunch of VCs. If you could share with people that aren't as familiar with private equity, just a little color. I remember you telling me, you're like, no, I don't invest where you guys invest. I invest a little later when I know if they're making money or not. And I love that. I was like, that's this. Email just got right to the point. Love it.
Yeah.
If you could share a little bit more about private equity.
And sometimes I hate to kind of say that they're different, because they're technically part of private market investing, private equity investing, right? Whether you are doing a seed or Series A or B, or even venture debt, right? Or if you invest in a convertible note, right, that converts into equity. I mean, it's all kind of private market investing. And quite frankly, the returns that you expect, whether you're an angel investor, right, or an institutional investor, should be pretty similar. You want to beat the stock market, quite frankly. Mm-hmm. And because it's smaller companies and it's not liquid, you want a higher return than the stock market. And so I try to explain it in those kind of simple terms, because at the end of the day, whether you're doing venture capital or you're going and you're competing with Blackstone and KKR at the big kind of billion-dollar buyout, you're trying to optimize for those returns, right? And so while I say, hey, I told you, we're investing a little bit more lower middle market style, right? It's still private equity. It's still private market investing. Now, I just like companies that are profitable already.
That's right.
And they've already built a real business. However, all that to say that one of the companies I'm looking at right now as a potential first portfolio company of Islos Capital was burning cash last year, but they reached a level where they're break even. And that's sort of an interesting kind of, I think, an interesting kind of part of their evolution, where they could be a venture play today, but we're looking at them and we might manage them in a different way. So instead of giving them maybe $10 million to burn, and then there's a question mark on whether or not they manage that efficiently over the next 18 months, I'm going to say, let's not burn that much. I'm okay with maybe burning 500K or $1 million, but in a way where 18 months from now, we're not like we don't have to raise more venture capital. And so that's where I think the worlds blend. And I think too many people think of them as very different. But in reality is, if you're trying to build a company, you're trying to build what's referred to as a going concern. You're trying to build a company that's here to last, not a company that is only growing because you're reliant on the next round of venture capital funding, right? Now, again, I can get into why you're reliant and why maybe the rocket ship that you want to build $2 billion, like it's necessary for you to rely on the next round of funding. But there's different philosophies. At the end of the day, if you're an angel investor or an early stage investor, you need to always ask yourself those questions. And what I tell people is figure out what is the right way for you to invest, right? Because it's your money, and it's not just because everyone else does it a different way, right? And I think that's what I hopefully, as we build East Coast Capital, we're sort of also helping, kind of educate folks on the fact that like the way they could invest in different ways, right? It doesn't have to be that I need to build a company that gets, investment from these 10 venture capital firms, and then they need to get investment from the next 10 venture capital firms, because, that may not be the right way to do it, right? And that may not necessarily maximize your return as the angel investor or the founder of the company.
That's great.
Sorry, I'm already on my first rant. Sorry about that.
I know. This is great. Love it. I do want to, since we're here, can you share a little bit more about what do you look for in an investment? Like what size investment do you make, and how, how can a company qualify to get money from East Coast Capital?
Got it. So I'll do a short answer for East Coast Capital, but then I also want to tell you that my partner and I have 23 portfolio companies that, quite frankly, were different parameters in how we made those decisions. But East Coast Capital in particular, if the company is profitable and has a minimum 5 million of trailing revenue, right? If it's software, we're okay. If that's ARR, if it meets that, and there's an opportunity for them to either become more tech enabled, meaning they can build better software for themselves, or they're selling some kind of technology service, then it's eligible. Versus venture capital, traditional venture capitalists, I personally don't care if the management team is good or not. It's a little controversial, but our whole strategy is predicated on the fact that we can invest if it's a good business that is not reliant on one individual, or even two individuals or a team of individuals. It's just that it's a good market to go after, and they've built something that's good enough to get to where they are at that moment. We have 30 technical advisors, where 2/3 of them are engineers and product managers, that any one of them should be able to take over that company. And when we tell the management team that's coming to us, we say, look, if you're good, we love you and we want to keep you as long as you can, but we also want to be thinking of like, if things change, they happen all the time. They like founder breakups happen, right? And you always want to almost plan for that to happen, because it could happen. Now, if it never happens, great, right? Then you have a great kind of investment outcome. Everyone's, sharing in the riches. But if it happens, that we're sort of ready to step in. And one piece of research that I was part of in the past is that the one of the biggest detriments to value creation for an investor is when they can't put the right person in the right seat of any company. And that's not just executives, it's also mid-managers. In fact, one of those detriments is when a mid-manager role is left open for too long, because sometimes the investor thinks, I only want to think about the CEO and maybe the CFO, COO, and they forget that the mid-manager keeps everything running on time. And that's sometimes even more important. In fact, sometimes the research has shown that even if you put someone who's not the best qualified, but just fills the role, they can actually help in the value creation over time, right? And so when you think about that, you think of all the biases, all the things you hear in the blogs about like, oh, it's all about the superstar founder, right? And if you're an investor, it's about a good company going after a good market, so that eventually, whether you're the rocket ship or just steady Eddie, 10-20% growth year over year, you can still have a good outcome. Like there's no one optimal way.
Yeah, I think
I went a little bit off tangent, but hopefully that's helpful in how East Coast Capital thinks about it.
No, that's great. It's good to give that perspective for the emerging fund managers looking to start, seeing the clarity in your focus and strategy that's important, and how you're executing that, right, with the team of advisors. And then how what's the approximate like check size when you guys are investing?
Yeah, I would say so. Just kind of getting on that spiel, it's 20 to 30 million would be the optimal, or the sort of what I call sweet spot. But we have capital partners that can help us go up to 75 if we need to. Broadly speaking, we say enterprise value of 100 million or less is the lower middle market sweet spot. So, whether it's 20, 30, for a 55, 60% stake in the company, then you do the math and you're sort of at that, anywhere between 30 and $50 million type of company is sort of that sweet spot.
Great. And I know we dived right into the meat.
You went for the goods right away, man.
we went in, but I wanted to take a step back and get let people get to know Emanuel. How did Emanuel come to be an investor? I mentioned all these things, from running for mayor to being on a transition team to serving. Can you walk us through that journey?
Yeah, not a straight line at all. Hopefully this makes people feel more comfortable with whatever non-jagged or jagged path that they've created. But I mean, growing up in sort of inner city LA, single mom, not knowing anything about any industry out there. What's an industry? But getting to Stanford sort of opened your eyes to say, hey, look, wow, there's all kinds of really smart people from all over the world, and I get to interact with them. And I think while I was there, I didn't even realize the importance of Sand Hill Road. Right now I know, but I didn't get it. And I just thought like, oh, I just want to do good in my community. Want to go back to the inner city and teach. That was essentially the way I thought that was the best way for me to drive impact. And over time, I said, well, maybe I could do other things, right? And I've run for office, right? I've done public service. I serve in the military, right? So I kind of still have the service aspect of impact. But then I as I got in politics and did other service, I also realized like fundraising broadly is important, right? Whether it's for nonprofits, political, or quite frankly, startups and companies, right? And that leads you, one thing leads to another, and you're like, well, what does that person do? And then you lead to like Wall Street, right? Which is sort of the gears of capital allocation broadly, right? It's how's capital allocated broadly, and why do people make decisions with their pocketbook, individuals, institutions? And so as I learned more and more, I sort of the impact through kind of allocation of resources is what has driven me to then at this stage in the game kind of think as broadly as possible and say, if I can kind of put myself in the middle of how capital is being allocated and put in the most effective place, right? So that you're actually creating value. That's not necessarily like I want to be a private equity investor. That just means that I want to help allocate resources in the most proper way. And that's where I think that sometimes people think, oh, you're an impact investor, and you're a non-impact investor. And I don't think that's the right kind of lens. I think if you're an investor, you know how to drive impact in wherever you're putting the capital to use, right? And so I think of like our firm and what we're building, it's not just about, hey, I want to just make a lot of money for myself or for my investors. Is that if I make a lot of money and treat people right, over time, those people want to continue being involved with you, and you're going to just continue building a stronger and better firm, right? And so back to like my neighborhood in inner city LA, right? If I could be independently wealthy and help other people enter this industry and also understand these kind of gears of capital allocation, then they're able to make impact in their communities, and they're able to do what they want to do with their capital and their resources. And that's how I think in the long run, I'll be able to still continue serving, still continue doing positive things. But it's sort of, I've been figuring out what the formula is to unlock this sort of, massive amounts of capital that are out there. And so, that's sort of the bigger kind of mission and why I'm, why I do what I do.
Great. No, I love saying the phrase invest is impact, right? And not it's, talking about that there's philanthropic concessionary funds where you may trade off for, investment, but then there's the straight, I'm just an investor, and I care about impact, and that is an externality of what I do, right?
Yeah.
So I think that's right on. We need more. We definitely need more of that. So how did you go from? I know you ended up in the financial world, you said, and then you talk about like why did you decide at that point, to serve in public office, like
Mhm.
in a sense, and then come back to investing. Can you talk through some of that thought pattern?
So once I got to Wall Street and I worked at Goldman Sachs right out of college, I think at that moment I was hooked on the kind of capital markets, and I wanted to be an investor. Now, anyone that is listening and understands anything about the investment industry, it is really difficult to get in. And if you don't follow a certain path from your sophomore year in college, where you get that first internship, and then nowadays you have to interview for your full-time offer your junior year before you even do your final summer internship. If you miss the boat, it's really hard for you to ever become an investment professional at an institutional private equity firm, right? And so when I had already graduated from undergrad, that's when I realized it. I was like, oh, I'm 22, 23, 24, and I'm too late. That's what I started thinking. And so part of my mission at that point was to like reject that notion of saying that I'm too late, and almost thinking like, how can I create my own playing field, right? This is a marathon, not a sprint. You hear that type of stuff all the time. How do I create my own playing field where I have home field advantage? I love sports. I'm an athlete. And I think of it that way. And I say, I'm going to make it so that I have the advantage, and I'm going to create the situation for me to have the advantage. So what does that mean? It means a lot of things, but you asked about public service or running for office. And one thing I learned by being the personal assistant to the former mayor of LA is that at the top, all the worlds collide.
Mm-hmm.
The politicians, the private equity investment professionals, the movie stars, entertainment people, the billionaires, the princes and kings and queens, like they all collide at the top, and they all talk to each other. And I think too much when we're young, we don't realize that, and we're sort of like in our silo, and we're just moving, and we just think that the next thing, we got to do the next thing, got to do the next thing, MBA, whatever, like, and you lose sight of, or you just don't know, you don't get exposed to the fact that at the end, everyone talks to each other. And so I think I got exposed to that really early on by just, being an assistant, working 7 days a week on a political campaign. And I said, you know what? Maybe there's another path for me right now to create my own way. And so at 25, I said, I'm going to run for Congress, and I'm going to be the youngest politician. And if I don't get it, oh, well, I'm still going to do what I do in terms of help people. And at minimum, there's going to be a spotlight on my neighborhood in East LA. But then, at maximum, I get in, and then I can kind of, impact things as, I'm going to be a 26-year-old, one of the youngest congressional members, talking to a 70-year-old congressional member and being on equal footing, right? Now, it didn't work out, but the kind of plan started working, because as a candidate for that region, even though that's a specific East LA, it was still Los Angeles.
Mm-hmm.
I still was reaching out to billionaires in LA and saying, hey, I'm going to be the next Congress member, back me. And I remember convincing a billionaire, I'm not going to say his name, but he wrote me a check to my campaign. Then I convinced a billionaire in New York. And it was like, it started kind of clicking. I was like, oh yeah, it does kind of converge. And I'm young, but I'm starting to see the dots connecting. I'm making this sound too short and too easy, but it, it takes work. You do it. And so then that's where I started kind of figuring out, okay, how do I chart my way to eventually becoming an investment professional at my own firm or another firm? One thing leads to another. Then I joined the Obama administration. I joined McKinsey and Company. I get operator experience at a tech company. And it's sort of, every step of the way, someone helped me get there. And then finally, I got to a private equity firm, and I was in my early 30s. And most people, they got to where I got to, that the people that get into private equity, they get there in their early 20s. So I got there 10 years later. Oh, well. But in those 10 years, I met billionaires, I met politicians, I met other senior people, and I understand decision-making and kind of interpersonal dynamics. And so it allowed me to essentially help this private equity firm on their founding team, build a new firm, raise a first fund, structure a team, create a strategy. And that led me to say, you know what, I can do it myself. And that's where I'm, doing it here at Islos Capital. So long story to
No, that's good.
public service was interwoven to, building your own investment firm.
And I no, I think service, knowing you, it's the service is a strong thread. Can you share a little bit more about the work you do with the Hispanic Heritage Fund?
Yeah, so I won the Youth or Hispanic Heritage Youth Awards, which are awards that organization that I'm now the chairman of the board of provides to some of the best kind of students, Latino students out of high school, about 200 a year. But for those 200, you get now we have 20,000 applications. Back then it was much less. It was easier to get it. That's probably how I got it. But anyway, we've created this great network. And so I went from, being an 18-year-old receiving the award to then going to college and being a volunteer, then an unpaid intern, then a paid intern, then like a kind of quasi staffer, quasi, volunteer spokesperson, and then an advisor, then a board member, and then the chairman of the board. So I sort of worked my way up on a nonprofit end, and I've served on 10 other nonprofit boards as well, but this is the one that I was the closest to, and that, quite frankly, the head of the organization has now been there for almost 20 years, and we've built this amazing chemistry where we just believe we're entrepreneurs, even though we're on a 30-plus-year-old organization founded by the White House in '87. We say we're innovating every day, and it's hard for nonprofits to do that because they're always reliant on sponsorships, on government grants or whatnot, on whatever independent sponsors. So we try to just continue pushing the envelope and saying, at the end of the day, we have the most amazing Latino network of talent. Let them lead us. And almost every program that has come through HHF has been an idea of a volunteer. And we just continue building it. The only one that's kind of stayed there has been the actual awards program that essentially is a feeder to building this network. And so I don't know, I love being the chairman of the board of the Hispanic Heritage Foundation. We nowadays, even though it's COVID-19, we do programs every single week. We're doing webinars on random issues that are impacting our community. So very proud of that work. We created Code as a Second Language, CSL. That's one of things that I'm the most proud of, that we've taught computer programming to kids in Latino and underserved neighborhoods around the country in about 60 different cities, which is pretty amazing. And so I could go on and on about impact work that way, but I also believe in that there's a lot of people doing this impact work. And so one of the things we talk about to our staff is that never be afraid of partnerships, always figure out how we're, kind of helping each other out and partnering with other organizations, and not being territorial, because there's plenty of money out there. But we're fighting for scraps sometimes, and we feel that way, and we just can't. We got to work together and, figure out how to do it together.
I hear you. Love it. And shifting, you've gone on this path, had a lot of success and moving. What has been some of the challenges along the way?
So on the private equity firm, fundraising is just tough for anyone, right? So, but I don't want to go down that path because everyone knows that that's hard. But I guess on my personal journey, is that no one would ever have said 5 years ago, oh, you're going to be the founder of a private equity firm. No one was going to tell me that. Same thing that no one's going to say, oh, at 29 years old, you're going to be the youngest mayor in 100 years of the city of Los Angeles. And I say these things in that no one is almost nothing in life, except for maybe at home with your parents, right? Almost nothing in life is that someone's just going to give it to you. Mm-hmm. And I try to say this a lot, in that you got to take it. And so I'm trying to take it. I'm trying to take it in life. And I've learned enough to have the confidence and I believe the knowledge base to take it, and to take it now. And so everything's tough, right? My mom, raising us by herself in inner city LA and seeing gang violence and, trying to keep her kids safe. And that was tough, right? My father-in-law working in construction, almost through COVID-19, working physical, demanding jobs every single day. That's freaking tough. And so everyone has it tough. And the few of us that are lucky enough to have access, that our ceiling is is either like imaginary or it's high, then and that we can kind of continue going up, then like we should do it, right? Because we can take it. And so, you know, I got to Stanford, like that means I should be able to compete with anyone in the world. Or, you know, if it's not Stanford, it's because you work at whatever company, one of the, you know, whatever company, if you worked in the White House and Treasury, like I got to do those things. And so I have a responsibility to make the most out of them. And it's going to be hard because sometimes people aren't going to believe in you, or they think that you got there for whatever reason, on, you know, you got lucky or something. But like, you know, no matter how tough it is, I just got to say, well, I belong. Oh, well, I'm sorry if you don't think I belong, but I do. And you know, I feel luckier that I believe that I can take it, and you may not, right? And I just, you know, it's easier said than done, but hopefully at least you remember this if you're ever, you know, facing that tough situation where, you know, no one is going to give it to you, and you just gotta be willing to take it if you want it.
And where do you think that kind of focus comes from for you?
For me, it's easy to pinpoint because it's my mom, you know, who crossed the border, you know, pregnant with me, and, you know, made it here. And you know, look, she didn't have an education. I mean, classic kind of immigrant story. And for me, it's kind of like, well, she did it. I have no excuse, right? Like she did everything she could to give me the better life. Like I got to do it. But then growing up, like my best friend, who was, you know, my best friend in middle school, who's no longer with us due to gang violence. He was just as smart as me. He was, you know, he was just as talented, but, you know, he walked down the kind of wrong path going home from school, right? And those things you kind of think about, at least for me, and I think about like, there's other people that just didn't have it, and I still do, right? I'm still healthy. I still got my limbs. I still got good health. I can still run. And so, you know, the fact that I can still do it, then I gotta push myself, because there's other people that would take even better advantage of the opportunities that I have, but they just don't have them, right? But I do.
Awesome. I no, appreciate you sharing that, and the journey. It's the winding journey. I can definitely speak to the winding journeys. But shifting, I wanted to shift back to on the investment side, what you were talking about before, and the role. I know you've been quoted in a few articles recently on everything that's going on with COVID, and the role of venture, that they have all this money that they should just throw it in and fix the economy. You know, I'll turn it to you. What you know, what role?
I have a lot of
What role does private equity play in this time?
So I have a lot of things to say about that, but I'll start with the misnomer of dry powder. Mm-hmm. Dry powder is not cash. It is not just sitting on the sidelines. Dry powder is what people refer to is committed capital that has not been called. Meaning, if I'm an investment firm, whether venture capital, private equity, or any asset class, I got legal documents that say that I can get that capital if I follow a process to call it. But when I call it, that capital is not just sitting in some vault or in some bank account ready for me to take it. It's being invested as well. It's being invested somewhere else. And if I'm on the other side of that, I'm a limited partner of an investment firm, then like I'm not, for the same reason, it's not just going to let it sit in a vault. I'm going to put it to work because I want to make sure I'm getting returns from it. And so this whole like dry powder world is that an investment firm could call the capital, but if you call it, that means it's being sold from somewhere else. So net, it's not like new money. It's just money that was invested somewhere else. So those assets, there's going to be downward pressure on, you know, because they're being sold, right? And the new assets then, you know, are getting bid up because more people want to buy them. But net to the economy, it doesn't make much of an impact. So that's the dry powder conversation. Now, in terms of like venture capital firms and private equity firms, this administration was clear, or at least Congress was, in that you know, funds that they were allocating, like the the PPP program, the Paycheck Protection Program. They were meant for companies to keep their employees, right? And that were impacted by COVID-19. And the truth is that the administration was not very clear. You had to read about it. You had to ask all the questions. And the administration, to their sort of credit and fall, is that they told the banks, don't worry about it. You're not liable. If they're your customers, just get the money out. So good, get the money out. Bad, banks don't really have to check on whether or not, that organization really needed the money or not. And so there was a lot of kind of, debate around whether or not, certain firms should have access, portfolio companies, private equity firms. What I say is, as a private equity investor myself, we're for lack of better terms, we're in the big leagues, right? We should be making institutional type investment decisions, and we should be planning for tough times. That's part of your investment, is to assess all risks and to assess when these things happen. And the fact of the matter is that private equity firms, especially the larger ones, have access to the Main Street lending facility, other lending facilities. They can tap capital markets to get access to funding. So my whole view is that, like, I love it when, my friends want to be like the most, capitalist, free market, blah, blah, blah. But then when the government has handouts, they're like, oh, me too, right? Like, come on, what happened, right? And so what I say is that, look, if you're in the big leagues, like, you need to act like you're in the big leagues. Otherwise, don't be in that seat, right? You don't need to be crying that you're not getting help from the government, because there's probably so many other ways that you could get help, right? But for the small business owner that's on the corner of your neighborhood, and they like the government made the program for them, right? And that's what it was meant for, not for the big portfolio companies of private equity firms. And the truth of the matter is that, like, some of our portfolio companies are small, but we should be there to help them, especially if it's a private equity firm that has a committed fund. So the SBA, Small Business Administration, has defined these rules for a long time, the affiliate rules and all that, and like, for us to for an investor to kind of come back and say, oh, I'm not being treated fairly by the government, when, like, all the other tax policy and so much of kind of other kind of institutional structures are set up to benefit you. Like, it's not time for us to cry. It's time for us to kind of bond together and figure out just how to make things happen as a community.
Absolutely. I mean, we all know there's pressure on the entire economy with the unemployment rate reaching the 20-25% range at this point, because of what is it, 33 million unemployed.
Yep.
It just incredible time. How do you think this will impact, or do you think going forward, when we come out of this in whatever that way that is, how is that impacting private equity right now? Like, when you're thinking about actually investing.
So I actually think this is an amazing time. If you have cash, if you have dry powder, right? If you have actual money to deploy, right? If you're an angel investor right now, this is beautiful. It's time for you to invest, because the price just went down from 2 months ago, right? Like, the company, the asset you thought of even potentially investing in 2 or 3 months ago is now much cheaper. As an investment person, it is time for you to buy, right? Now, I can get into, like, whether or not this is going to be a recovery that's going to come right back in a few months, or it's going to be sideways for another year or two. Whatever it is, I'm saying today versus 3 months ago, very different. And if you were willing to pay something 3 months ago, like, you should be willing to pay. You're not going to be able to pay much less for the same asset. So fundamentally, like, pure math, it is much better for you to buy today than it was 3 months ago. So I mean, that's kind of the short, very straightforward answer. And so a lot of private equity firms that had that capital and weren't deploying it as actively, they're chomping at the bit right now. They're looking for companies. Now, the issue is that a lot of people don't have conviction, because maybe they haven't done enough research, or they're not sure what to buy. That's a whole different scenario, right? But if you're a professional investor, like, that's your job. Your job is to figure that out.
And do you think there'll be any lasting change on the industry? Has it changed? I mean, it sounds like, it's a cycle of the market. There are more deals now, right? But do you think I think of pandemics and our institutional memory, because it's been so long ago, right? Since we globally been through
Yeah.
something like this. Do you think there's going to be any fundamental changes, or is it just managing this temporary period until we get a vaccine, and then back to business? What do do you have
So
thoughts?
so so I am in the more bearish camp
Hmm.
of from a recovery standpoint, because absent COVID-19, we were already over levered, and we were artificially, through bringing down rates by the Federal Reserve
Yeah.
and pumping money into the economy, we were artificially making this economy continue going forward and up, right? So forget COVID-19, like we were already afraid. My partner and I, and like our view, we're a little bit in the more bearish camp. There's more consumer credit card debt out there, right? There's more levered loans. Like there's so much debt out there. The U.S. debt has grown faster than U.S. GDP since 2009, right? So that doesn't make me feel confident in the markets. That's without COVID-19, right? So I am very bearish in terms of what, like, even the fact that the Federal Reserve put $10 trillion of liquidity in the last month, that is the reason why the stock market's up right now. But the real economy was could already have fallen victim to a sort of contraction of the credit cycle. But now that the Fed has pumped that money in, it might go sideways for a longer period of time. And so, we're sort of, here, wait and see, right? In terms of what ends up happening. So that's my personal view. However, when you say, like, will society change, right? I am much less in the dramatic camp of, like, oh, everything's going to be very different. And like, I'm not in the alarmist, spectacular camp. Like, trust me, the moment we can go back to work, people want to get back in an office, or they want to be with their fellow colleagues. Like we're social creatures. Like we want to go back, right? So yeah, might there be more remote employees? Yeah, but it's not like going to be fundamentally different, right? There was already a trend towards that anyway. This maybe accelerated that a little bit, but I'm not in the camp of, like, it's going to be a whole different world, right? Might there be new procedures to go into public places? Maybe, right? 9/11 changed that, but now it feels normal, right? Going through TSA. And so there's going to be things that are going to change here and there, but I'm not in the sort of alarmist, spectacular camp. Like, we want to get back to work and back to normal. And the recovery, in my view, is going to take longer than what most people think. But like, I think in general, people just want to get back to how we were before, and they know that they're going to have some new procedures in place to make sure, that everything's fine, or that we kind of prevent future outbreaks of COVID-19, or quite frankly, anything else, right? I mean, Bill Gates was saying this for the last 5-10 years of, the fact that one of the, worst situations for our economy or our society is an outbreak of some disease or some virus. So we're prone to that, and there could be something else that happens in the near term or midterm. So that's quite frankly the things that we should be aware of. And as an investor, you need to think about that, right? Like, this doesn't, the fact that this happened now, it doesn't mean that it's going to wait. We need to wait 100 years for a new, pandemic. Like, this could happen in 5 years from now. And as an investor, you need to understand that. And that's just the realities of investing, and that however things happen in the last 5 years, 10 years, even 20 years, that doesn't mean the next 20 years are going to look the same. They could look very different.
That's great. That's great. And I know you said things may go sideways, or it may take longer than we think. Can you share a little color on what do you mean by that? How
Sure.
long will it take, and what do you think it'll look like?
So look, the stuff the federal government and the Federal Reserve has done is essentially a massive Band-Aid that they put on society, and they gave us a lot of stuff to play with in the interim, right? From liquidity to the fact that, like, some companies are getting bailouts, right? Like, there's a lot of things that are sort of supporting the economy, and that's why the market bounced back from being like down 35%. it's now only down like 12% off their highs, right? It's crazy, like what's happened. But the real economy, it has over 30 million unemployed. Like that's crazy. And so even though for 2 months, 8 weeks, a small business can have this, payroll protection program, like that's going to run out. I think United Airlines just said that the moment they could lay off people, they're going to lay off people. Mm-hmm. And I think that's like September, October or something. So like we are right now massively being like held up by the Federal Reserve, and the Federal Reserve needs to continue holding us up, right? Or we're going to fall at some point. And I am in that camp that we're probably going to fall again. We're going to trip up. And then going back to the fact that we were already at like historic highs in terms of leveraged loans and consumer credit card debt and all that other stuff. Like, it's natural for economies to contract based on credit cycles. And so that's what I'm more afraid of. And why I think I am definitely in the more bearish camp on where the economy is going to be in the future. And so right now we're kind of living in this artificially lifted up world for the next, call it, 3 to 6 months. But, the next 9 months are not going to be easy. And so maybe if I tie it back to investing in venture capital and early stage, right? Like if all my portfolio companies, if they didn't raise money in the last 3 to 6 months, I say your new budget needs to think about 18 to 24 months without raising capital and survival, right? And that's just the reality, because you don't know what's going to happen. And right now we're sort of living in this very artificially lifted time frame with the Federal Reserve pumping $10 trillion of liquidity into the market.
Great. Thanks for that insight and the clarity behind that. I want to share.
I could get more technical, but I don't, it's.
No, it's great. It's great. Do you want to share? Do you want to share more? You could dive deep. It's fine.
Yeah. I mean, look, so businesses need they need capital to grow, but they need an economy to grow. And I say the best capital that you raise is a new customer, right? And when customers aren't there, they're not showing up, it's not just the airlines and hospitality and restaurants, it reverberates through the whole economy. And so, there's a lot of companies that I'm looking at that are software companies. They're like, oh, we're not affected. We're this COVID-19, it's affecting the other folks, right? But that's just not like, they're just, you're being artificially lifted, but you will get affected. And almost every industry is getting affected. And that's what I think a lot of people are kind of losing sight of, in that, if United Airlines lays off people, those people are going to spend less money in the economy, right? And that's not just consumer, but it's the consumers, but then it's all the B2Bs, right? All the companies that are selling to those consumer companies, they're going to have less, revenue. And so it just kind of reverberates on the economy, down different industries. And then the whole debt thing that I talked about, if I borrowed at 6 times profitability, 6 times EBITDA, and now my EBITDA is cut in half, I now have borrowed at 12 times EBITDA. So that's bad, right? That's not good. And I may not be able to meet my debt service. And then when you think of like fundamentally back to like the basics of capital allocation and putting it to productive uses, if now most of my profitability is going to pay down debt, I have less to invest in R&D. I have less to invest in making my company grow, because I'm just trying to survive and pay down the debt. And so that's getting more technical, where you're sort of now looking at balance sheets of individual companies. You're looking at the income statements of individual companies, and you're saying, oh, shoot, I got to meet this debt service. And that's the only way that I can survive. So therefore, I used to think I could grow 30, 40% year over year. Now I'm only going to grow 15% year over year, because I need to meet my debt service. And those are the things that are going to start happening throughout the economy that is going to hurt a lot of companies. Just three months ago, or less, even 2 months ago, I mean, banks were lending, and then there's all these non-bank lenders out there, led by the Apollos of the world, that essentially allow companies to borrow more than 3 to 4 times EBITDA. They're borrowing like another 2 turns, which is meaning if you say every turn, it's like a multiple of your EBITDA. And so you're going from 3 times borrowing to 6 times borrowing by going to non-bank lenders, in some places even 7 or 8 times your EBITDA. And all those companies, I mean, that's just irresponsible way of managing your financials. But that's what was happening. And a lot of those companies are not going to survive. which means more layoffs. And again, that reverberates throughout the economy. Right now, though, we're in an artificially lifted world, and those companies are surviving because they either tapped into PPP or they're tapping into the capital markets to borrow money at like 0% interest rates. And that's why we're still sort of kind of petering about, and the stock market keeps on, either going up or sideways instead of going down.
That was great. I'm glad you went deeper. Shifting into on the same topic and taking a step back for the average person thinking about this, thinking about they want small businesses to survive, and they want, like, what can we do as individuals going forward now, besides, you said, investing in things that are solid, that are on discount now, there's that, but what are other things that we can do now in this time to survive and thrive?
So by we, there's a lot of different we's, right?
Yep.
If I'm a small business owner, I want to have as much of a cash cushion as possible, because I don't know how bad it's going to be, and it is survival mode. And if I can get cash, if I can borrow today, then I will borrow to at least keep it as cash, not to use the cash, but to just make sure that I have cash. So that's on a business level. If I'm an individual and I'm not in a good shape financially, like, you need to kind of, unfortunately, I mean, the individuals are going to be the worst off, because either, if you have a job, then save as much money in your job, and if you don't have a job, like, unfortunately, you have to try to find a job. So maybe this is a little bit of a segue to like one of the companies that I'm invested in, Sabio, which is a coding bootcamp, and it's technical training. Quite frankly, I've advised a lot of my friends, if you ever thought about becoming a software engineer, or maybe not full-fledged software engineer, but learning about technology from a, like, actually writing code perspective, maybe now's the time, right, to do it. You have unemployment insurance. You might want to consider it right now, because whatever job you're in, even if you don't become a full-fledged software engineer, the more technical you are, the more likely your job is going to stay or be around in the long run. So maybe taking a step back, and if you're not a full-fledged software engineer, this is the time for you to upskill and just get more skills, so that you can be in a better place in the job market in the future, if you don't have a job today. In terms of as an investor, I still think, even if it goes sideways, the economy, for a while, if you can buy a good business right now, the price just went down, like I said before, don't be afraid of deploying capital, because you might just get, like, you might just make the best investment decision that you've ever made. Because if I'm wrong and it's not bearish and the market goes up right away, you just benefited. If I'm right and I'm bearish, at least you're in a good business, and you're essentially helping that business operate and hopefully growing, over time. So hopefully that's a few different we's right there.
I appreciate that. That's great. So I know we took enough of your time, Emanuel. Everyone, this is Emanuel Pleitez. Thank you for joining us tonight, Emanuel. It was great. So appreciate your insight.
My pleasure.
And
thank you. Pardon the COVID beard. I haven't shaved in I forgot all along. I think since shelter in place, I don't think I've shaved.
No, you're, what is it? I was gonna say, you're one of the second. You're the second interview that I saw. I saw another, Tony Wilkins from Chicago. He had a beard as well. I've never seen him like that. So it's great. It's great to see a little bit.
Don't tell my army buddies.
See everyone a little bit more relaxed. But thanks for joining us. For everyone watching, this is Rebel One Live. Join us every Tuesday through Thursday, 7 p.m. To hear amazing founders and investors focused on investing and impact. So thanks, Emanuel.
All right.